Welcome to CoreLogic's housing market update for June 2020. It's great that as a nation we've flattened the virus curve back to virtually nothing over the past month, and subsequently many of the social distancing policies that have impacted on housing markets and economic activity have either been relaxed or lifted. Some states have opened up their borders, and in most areas the number of home sales has shown a substantial improvement relative to the sharp fall in April. The downwards pressure on home values became more broad-based in May. The National Home Value Index was down by 0.4% over the month, with 5 of the 8 capital city regions recording a fall in values. Considering the weak economic conditions associated with the pandemic, a fall of less than 0.5% in housing values over the month shows the market's been, so far, remained pretty resilient to a material correction. With restrictive policies being progressively lifted or relaxed and economic conditions showing some early signs of improving, the downwards trajectory of housing values could be milder than we first expected. Across the state capitals, Melbourne's housing market has posted the largest falls over the month, down by 0.9% in May, following a 0.3% reduction in April. Values were also down over the month in Perth, in Sydney, Brisbane and Darwin, but they rose in Adelaide, Hobart and Canberra. Regional markets have been more resilient to value falls, with the combined regionals index holding firm through May. Although housing values are currently slipping or stabilising, recent history implies that most homeowners have some level of buffer that will help to protect against negative equity. National home values remain 8.3% higher than they were a year ago, with Perth and Darwin the only capital cities where values remain lower than at the same time last year. The high annual capital gains is mostly attributable to the earlier growth trajectory of housing values across Sydney and Melbourne, with the remaining capitals showing a more sustainable history of price rises. Despite the loss of momentum of housing value growth, buyer numbers have shown a solid rise in May. After housing market activity fell by around 1/3 in April relative to March, sales activity bounced back by an estimated 18.5% in May. Housing market activity remains well below average, however. The rise in sales through May coincides with a consistent rise in consumer sentiment and eased social distancing policies through the month. With consumers feeling more confident, households are better equipped to make high commitment decisions such as buying or selling a home. A lift in housing market activity should also support broader economic activity, with housing turnover providing a positive flow-on effect to other sectors including the retail sector, construction and banking. Improved confidence is also flowing through to a rise in new listing numbers. The number of fresh property advertisements bottomed out at an historic low in early May, with the rolling 28-day count up 22% compared with the end of April. Although new listing numbers are trending higher, the total listing count, which includes new listings as well as relisted properties, has continued to trend down, implying a healthy rate of absorption as buyers become more active. The relationship between new listing numbers and total listings will be a key trend to watch. If total stock levels become elevated, this indicates that supply levels are outweighing demand. Currently, this doesn't look to be the case. Auction market indicators provide another confirmation point of improving conditions. The combined capital city clearance rate bounced back from a low of about 30% in April to nearly 63% in the week ending 24th of May. As policies preventing open homes and on-site auctions eased during May, there was a clear improvement across auction markets. We've seen a sharp reduction in the number of auctions being withdrawn, and more vendors are testing the market under auction conditions rather than accepting an offer prior to the auction. Overall, the broad theme we're seeing in much of the housing data is a mixture of resilience and recovery. In the context of weak economic conditions and the broader COVID-19 related disruption, housing values have been relatively resilient through May. If history is anything to go by, housing values have generally weathered periods of extreme uncertainty quite well, and the trend to date looks very similar. Buying and selling activity was heavily impacted in April, but the month of May saw this trend reverse in line with the flattening of the virus curve, eased social distancing measures, and improved consumer sentiment. As more vendors have tested the market, listing figures suggest more buyers are also coming to the market, indicated by the strong absorption of new stock. While the downside risk remains, the trajectory of the housing market is looking more positive than what we were expecting a bit over a month ago. While the immediate indicators are showing resilience or improvements, the longer-term view of the housing market is much less certain. Once stimulus measures start to taper and repayment holidays expire, this is where we could start to see a rise in mortgage arrears and the potential for a lift in distressed sales. Despite the recent recovery in certain economic indicators from very low levels, it's hard to ignore job losses of almost 600,000 across the economy in April. With the cash rate at its lower effective bound, improved employment conditions will be a factor in steadying purchasing capacity for housing and the servicing of mortgage debt. Central to the outlook for distressed sales will be what shape is the Australian economy in later this year. Encouragingly, the RBA Governor recently noted in his evidence to the Senate Select Committee on COVID-19 that the economic downturn may not be as severe as earlier thought, with the current economic trajectory somewhere between the RBA's best case and base case scenario. No doubt the coming months will provide more guidance on how the housing market and economic conditions are playing out. The implications of grants and stimulus for new housing construction and renovations should also become clearer as more details are released through June. Keep up to date with all this news and more at the research pages at the CoreLogic website at www.corelogic.com.au.